Welcome to your Federal Retirement Annuity. I'm Dave Johnston with OPM. This is an overview of the annuity benefits available to civilian federal employees who retire under the two most common retirement systems, the Civil Service Retirement System, known as CSRS, and the Federal Employees Retirement System, known as FERS. This information is current as of March 2017. The federal government has several different retirement systems for its employees. Today we'll cover the most common ones: the Civil Service Retirement System, CSRS, Serves Offset, which includes Social Security benefits, and the Federal Employees Retirement System, FERS. As we go forward, information about CSRS will be flagged with the color red. Information about FERS will be flagged with the color light blue, and information that applies to both CSRS and FERS will be flagged with the color purple. But before we go any further, it's important to find out which one is your retirement system. You can ask your employing agency's Human Resources Office, or you can look at Block 30 on your most recent SF50 Notification of Personnel Action. Here's what your SF50 Notification of Personnel Action will look like. You may be able to download your most recent one from your Electronic Official Personnel Folder, EOPF, or from your agency's internal Human Resources portal. Follow the arrow to Block 30. It shows the civilian retirement system where deductions from your pay are currently going. These are the most common codes you might find in Block 30 of your form. Make a note of the code in your Block 30. You'll need this information to find out what parts of today's guidance apply to you. For most people, you will see code K, indicating that you are paying into the FERS retirement system. If you're in a retirement system that we're not covering today, such as the Foreign Service Retirement and Disability System, contact your employing agency's Human Resources Office for guidance. If after today's presentation you believe you've been placed in the wrong retirement system, you may be able to apply for relief under the Federal Erroneous Retirement Coverage Corrections Act, or FERCA. Contact your employing agency's Human Resources Office for assistance. The federal government's oldest retirement system is the Civil Service Retirement System, CSRS, which was established in 1920. CSRS is a defined benefit retirement system, meaning it provides a specific monthly annuity based on your salary, years of service, and age. It's also a contributory retirement system, meaning employees pay into it. Most employees pay 7% of their income, and their agency matches 7%. Special laws allow some employees, such as law enforcement officers and firefighters, to pay more, 7.5%, and get an enhanced annuity benefit. Most CSRS employees who started service before 1984 do not pay into or receive Social Security. CSRS employees also have the option of paying into a voluntary contribution account to make their future annuity larger. Contact your agency's Human Resources Office if you're a CSRS employee interested in a voluntary contribution account. In 1984, Congress changed the law to require federal employees to start participating in Social Security. They established CSRS Offset, which is similar to the Civil Service Retirement System, but with smaller retirement contributions and annuity benefits that are offset by Social Security contributions and benefits. Which employees have CSRS Offset as their retirement system? Employees hired on or after January 1st, 1984, most senior officials working in 1984, and employees who had 5 years of creditable service by the end of 1986 and who rejoined federal service after a year-long break ending in 1984 or later. If you are in CSRS or CSRS Offset and you're getting ready to retire, take a look at Standard Form 2801, Application for Immediate Retirement. It's available at www.opm.gov/forms. Then click Standard Forms on the left side of the screen. In 1987, Congress changed the law again to establish the Federal Employees Retirement System, FERS. When you retire under FERS, typically you'll be getting retirement income from 3 different sources. One is the FERS Basic Annuity Benefit administered by OPM. Another is Social Security. You'll be paying Social Security taxes while you're employed under FERS and collecting Social Security benefits after retirement. And you'll be receiving income from your Thrift Savings Plan, a retirement investment account similar to a 401k. Employees hired in 1987 or later typically have FERS as their retirement system. Standard FERS contributions are 0.8% of your salary. In 2012, Congress changed the law to require new federal employees hired in 2013 or later to pay 3.1% of their salary in retirement contributions. Remember that existing FERS employees pay only 0.8%. These 2013 FERS employees are known as FERS-RAE, for Revised Annuity Employee. This revised annuity contribution also applies to employees rehired in 2013 who had less than 5 years of creditable service toward retirement. The law also required new members of Congress and congressional employees to pay the increased contributions and ended their enhanced annuity computations. The Bipartisan Budget Act of 2013 created another new category of FERS employees. The federal employees hired in 2014 or later pay 4.4% of their salary in retirement contributions. Most FERS employees still pay only 0.8%, and FERS revised annuity employees, the ones hired in 2013, still pay 3.1%. The employees hired on or after 2014 are called FERS Further Revised Annuity Employees, or FERS-RAE. If you are in FERS, FERS-RAE, or FERS-RAE and you're getting ready to retire, take a look at Standard Form 3107, Application for Immediate Retirement. It's available at www.opm.gov/forms. Then click Standard Forms on the left side of the screen. There are several different types of retirement, and we're going to cover them in a moment. Regular or optional retirement, early retirement, disability retirement, retirement under special provisions, deferred retirement, discontinued service retirement, and phased retirement. In this presentation, we will primarily cover the most common types of retirements, regular and early retirements, but we will touch on some of the others. Under CSRS, you can retire voluntarily as long as you're 55 or older with 30 years of federal service, 60 or older with 20 years of service, or 62 or older with 5 years of service. Under FERS, you can retire voluntarily as long as you reach your minimum retirement age with 30 years of federal service, age 60 with 20 years of service, or age 62 with 5 years of service. FERS also allows you to retire if you reach your minimum retirement age and have only 10 years of service. But as we will discuss later, there can be big reductions in annuity benefits for people who use this MRA plus 10 retirement. What is your minimum retirement age under FERS? If you were born before 1948, it's 55 years old. If you were born in the late 40s or early 50s, add 2 months for every year 1948 to 1952. For example, if you were born in 1949, your minimum retirement age is 55 and 4 months. That's 2 months for 1948 and 2 months for 1949. If you were born between 1953 and 1964, your minimum retirement age is 56. If you were born in the mid to late 60s, add 2 months for every year starting in 1965. For example, if you were born in 1966, your minimum retirement age is 56 and 4 months. That's 2 months for 1965 and 2 months for 1966. If you were born in 1970 or later, your minimum retirement age is 57. Early retirements are only available in special situations, such as when your agency is reorganizing, when there is a reduction in force, or when you have an involuntary separation, like when your position is being eliminated. Involuntary separations cannot be for misconduct or delinquency. Your agency must ask OPM's permission to offer an early retirement, and OPM must approve the request. If you are eligible for an early retirement, you can retire at any age with 25 years of service, or at age 50 or older with 20 years of service. These early out retirements apply the same to CSRS and FERS employees. Under CSRS and FERS offset, you can retire on the last day of the month, and your annuity will begin on the first day of the next month. Or you can choose to retire on the first, second, or third day of the month, and your annuity will begin the next day. Keep in mind that your monthly annuity pays you for the previous month. So, for example, your annuity payment on March 1st is paying you for the month of February. If you retire on January 31st or on February 1st, 2nd, or 3rd, you would get a payment on March 1st for the days in February that you were retired. If, however, you retire on the 4th of the month or later, your annuity will not begin until the first day of the next month. In our example, retiring on the 4th of February would not start your annuity until March, and the first payment you would receive would be on April 1st for the month of March. That would leave you with no payment on March 1st and several weeks in February that you're not getting paid for. For FERS, you must retire on the last day of the month for your annuity to begin the next day. If you retire on any other day, your annuity will not begin until the first day of the next month. To avoid these unpaid days or weeks, FERS employees should retire on the last day of the month. There are exceptions for a discontinued service retirement when your annuity would begin the next day. Creditable service is very important because it determines when you can retire and how much of an annuity you will get. Typically, we count your federal civilian service from the beginning date of your appointment to the ending date of your appointment. But there are exceptions. If you are on leave without pay for more than 6 months in a calendar year, you will not get credit for the months in excess of 6. So if you're on leave without pay for 8 months, say from January through August, you will not get credit for July and August, your 7th and 8th months of leave without pay, and you'll only have 10 months of creditable service that year. Another exception is a when actually employed or intermittent time appointments. These employees are basically on call for an agency and only get service credit for the days they actually worked. Also accepted are seasonal when actually employed appointments and seasonal intermittent employments. These employees are common in the IRS during tax season, in the USDA during harvest season, etc. For these employees, time in a non-duty or non-work status is treated just like leave without pay. You can have up to 6 months of non-duty or non-work status and still get credit for the full calendar year. You can get credit for your military service as long as it's honorable, active duty service. If you receive military retired pay, In most cases, you will need to waive that pay to credit your military service toward your federal civilian annuity. There are exceptions to this waiver requirement for reserve retired pay and for pay for a disability incurred in combat caused by an instrumentality of war during a period of war. If any of your military service was in 1957 or later, you may need to make a military deposit to credit that service toward your civilian retirement. For CSRS and FERS offset, the military deposit is 7% of your military base pay plus interest. For FERS and FERS-RAE, the military deposit is 3% of your military base pay plus interest. There is an alternative computation for military deposits paid under Uniformed Service Employment and Reemployment Rights Act, also known as USERRA. Suppose you are under CSRS and you had some service where you paid into Social Security, but not into the CSRS retirement fund. This is common with temporary, term, and indefinite appointments, and it's called non-deduction service. If that service occurred before October 1, 1982, then it's creditable toward your eligibility to retire and toward your retirement annuity. You have a choice whether to pay a deposit for this service. If you choose not to pay a deposit, OPM will calculate how much you would have paid in retirement contributions during that service, plus interest, and OPM will reduce your annuity by 10% of that missing contribution amount. If that non-deduction service was performed on or after October 1982, it's still creditable toward determining whether you have enough service to be eligible for retirement, but you must pay a deposit for that service if you want it credited toward your annuity calculation. If you have non-deduction service like this, while your retirement application is pending, OPM will send you a letter showing how much your deposit would be and how much your annuity benefit will change if you pay the deposit. FERS is simpler. For non-deduction service performed before 1989, you must pay the deposit to credit this service toward your retirement eligibility and annuity computation. While your retirement application is pending, OPM will send you a letter comparing your options. For non-deduction service performed on or after 1989, generally you cannot credit this service toward your retirement eligibility or your annuity benefit, even if you pay a deposit. There are exceptions to this. Foreign service employees under the Foreign Service Retirement System, Peace Corps and Vista Service, and other exceptions can make a deposit and be credited for non-deduction service in 1989 or later. How much is the deposit? For CSRS and FERS offset, it's 7% of your earnings during that non-deduction service plus interest. For FERS and FERS-RAE, it's 1.3% of your earnings during that non-deduction service plus interest. Suppose you made retirement contributions, then separated from federal service for more than 30 days. You applied for and received a refund for your retirement contributions. This is known as refunded service. Under CSRS, refunded service ending before March 1991 is creditable for retirement eligibility and annuity computation. But if you do not redeposit the contributions that were refunded, then your annuity will be reduced based on the amount you owe and your expected lifespan. This is known as an actuarial reduction. OPM will send you a letter while your retirement application is pending to explain your options. Under CSRS, refunded service ending on or after March 1991 is generally creditable for retirement eligibility, but you must redeposit the contributions that were refunded to you with interest if you want that service credited toward your annuity calculation. OPM will send you a letter while your retirement application is pending to explain your options. For those retiring after October 28, 2009, FERS Refunded Service is creditable toward your eligibility to retire regardless of whether or not a redeposit is made. But if you do redeposit the retirement contributions that were refunded to you with interest, then you can credit that service toward your retirement eligibility and your annuity calculation as well. A survivor, such as a surviving spouse, can also make this redeposit if they want to maximize their survivor annuity. More on survivor annuities later. For both CSRS and FERS, unused sick leave can be credited toward your annuity benefit calculation, but not toward your retirement eligibility. For example, if you are age 60 with 19 years of service and a year of unused sick leave, you're not eligible to retire. You need 20 years of service at age 60. But if you are age 60 with 20 years of service and a year of unused sick leave, your annuity will be calculated as if you had 21 years of service. Now, to the big question everyone wants answered, how much of an annuity benefit will I get? Your basic annuity is based on your high 3 average salary. Start by finding the 3 consecutive years of service when you earned the highest pay. These are usually your last 3 years of service. The 3 years do not need to be continuous. They can be separated by a break in service. But the years do need to be consecutive. If you've been continuously working for the federal government for 20 years, you cannot pick 1 year at the beginning of your career, 1 year in the middle, and 1 year at the end. These also do not need to be calendar years. Any qualifying 12-month period will do. With grade and step increases, it's possible you had more than one salary during any 12-month period. For your high 3, we will need to calculate an average salary that is weighted to factor this in. A qualifying 12-month period can include a break-in service of 3 calendar days or less. But if the break-in service is 4 calendar days or more, then the break begins a new 12-month period for the purposes of high 3. If you were in leave without pay status for less than 6 months, you can still use that year in your high 3. But if you were in leave without pay for more than 6 months, you cannot count that time as part of your high 3. Military pay cannot be used in calculating the high 3 unless the military service interrupts the civilian service and the employee exercises reemployment or restoration rights. In that case, civilian pay is projected over the period of military service, and military pay can be used to calculate the high 3. The type of pay used in high 3 is your basic pay. Basic pay includes regular pay, locality pay, certain types of night differential for wage employees, and certain types of premium pay for firefighters and law enforcement officers. If you receive night differential pay or premium pay as a firefighter or law enforcement officer, check with your employing agency's Human Resources Office to see if yours qualifies as basic pay for your annuity benefit. Basic pay does not include bonuses, overtime, allowances, or special pay for recruiting and retention. Your first step is to calculate your high 3 average salary. Start by finding the 3 consecutive years when your salary was the greatest. Remember, these can be any consecutive 12-month periods, not strictly January through December. Then, separate these years into 3 12-month segments. For each segment, identify the salary or salaries you had during that time and the number of days you had each salary. Here is a simplified example to show you how it's done. Karen started work on February 1, 1987, and retired January 31, 2017. With the exception of one stretch between 2002 and 2003, her salary generally increased over time, and she saw her highest salaries in her last years of service. Like with most employees, her high 3 will be based on her last 3 years of service because those were the years when her overall salary was greatest. The 3 consecutive years she will use are February 1st, 2014 to January 31st, 2015, February 1st, 2015 to January 31st, 2016, and February 1st, 2016 to January 31st, 2017. Notice how an employee can have more than one salary during any given 12-month period. For the first 2 of her 12-month periods, she had one salary for 334 days and a different salary for the last 31 days. This information will help us weigh her average salary on the next slides. Now, grab a pen and a calculator. It's time to do some math. Pick one of the 12-month periods. Multiply your basic pay at that time by the number of days you had that basic pay out of the 365 days in the year. Do this for each basic pay you had during that period. So for Karen's first 12-month period, she had a $70,000 salary for the first 334 days and a $75,000 salary for the last 31 days. Multiply 70,000 by 334 divided by 365, and you get $64,055. Then multiply 75,000 by 31 divided by 365, and you get $6,370. Add these two sums and you get her weighted salary for this 12-month period, which is $70,425. As you can see, her weighted salary is weighted closer to $70,000 than $75,000 because she spent much more of the 12-month period making the $70,000 salary. Repeat this process for each of the other 2 consecutive 12-month periods that you identified earlier. In Karen's case, her second 12-month period had a $75,000 salary for the first 334 days and an $80,000 salary for the last 31 days. Multiply 75,000 by 334 divided by 365, and you get $68,630. Then multiply 80,000 by 31 divided by 365, and you get $6,795. Add these two sums, and you get her weighted salary for this 12-month period, which is $75,425. In Karen's last 12-month period, her salary did not change. In that case, there is no math. Her average salary during that period is her only salary during that period, $80,000. Your last step is to add up these 3 weighted annual salaries and divide by 3. For Karen, that's $70,425 plus $75,425 plus $80,000 divided by 3, which equals $75,283. This is her high 3 average salary. Once you have calculated yours, you're ready to move on. In most cases, you can apply a general formula to your high 3. The general formula is used to calculate basic annuities for voluntary, early voluntary, discontinued service, and deferred retirements. It's also used to calculate disability retirements when the employee is over age 62 or the earned annuity is greater than the disability guaranteed minimum. If you are under FERS, use this formula. First, multiply 1.5% by your high 3 salary, then multiply again by 5. This represents your annuity for your first 5 years of service. Set aside this number. Then multiply 1.75% by your high 3 salary and multiply again by 5. This represents your second 5 years of service. Set aside this number as well. Finally, multiply 2% by your high 3 salary and multiply again by the years of creditable service you have in excess of those first 10 years. Now, add all three numbers and you get your FERS basic annuity benefit. Let's go back to our example. Karen has 30 years of creditable service, and we calculated her high 3 average salary at $75,283. We multiply 1.5% by $75,283 by 5 to get $5,646. Then we multiply 1.75% by $75,283 by 5 to get $6,587. Finally, we multiply 2% by $75,283 by 20 years to get $30,113. We used 20 years here because she had 30 years of service, and we already counted the first 10 of those years in the first 2 rows. Add up those three numbers and you get a basic FERS annuity of $42,346 per year. If you are under FERS, use this formula. Multiply 1% by your high 3 salary by your number of years of FERS service. Or, if you are retiring at age 62 or older with at least 20 years of service, use 1.1% instead. It's that simple. For our FERS example, let's take a 62-year-old employee who has 24 years of service and a high 3 average salary of $48,000. Because she is retiring at age 62 or older with at least 20 years of service, we use the 1.1% multiplier instead of 1%. 1.1% times 48,000 times 24 years equals a FERS basic annuity of $12,672 per year. Don't be alarmed by that figure. Because this is FERS, that annuity will be supplemented by Social Security benefits and by your thrift savings plan if you contributed. If you have spent time under both CSRS and FERS, apply the CSRS formula to your time in CSRS and the FERS formula to your time in FERS. Let's return to our example from the last slide of a 62-year-old employee with a high 3 salary of $48,000. But now, she's retiring with 30 years of service, her first 20 years in CSRS, and her last 10 years in FERS. For her CSRS portion, we multiply 1.5% times 48,000 times 5 for her first 5 years in CSRS. Then 1.75% times 48,000 times 5 for her second 5 years in CSRS. Then 2% times 48,000 times 10 for her remaining 10 years in CSRS. Add those three numbers and you get $17,400. For her FERS portion, we multiply 1.1% times 48,000 times the 10 years she was in FERS, and we get $5,280. Again, we use the 1.1% multiplier instead of 1% because she is retiring at age 62 with at least 20 years of service. Add 17,400 with 5,280, and you get her basic annuity of $22,680 a year. Some FERS employees are eligible to retire before age 62, but Social Security typically doesn't begin paying out until age 62, and Social Security is a big part of a FERS retirement. To solve this problem, qualifying FERS retirees can receive a FERS annuity supplement until they reach age 62. FERS will estimate the Social Security benefits that you earned during FERS civilian service and pay you that supplement. The supplement is subject to an earnings test just like Social Security benefits themselves. So if you work after retirement, your post-retirement earnings could reduce or eliminate your supplement. To be eligible for the supplement, you must have at least one full calendar year of retirement deductions under FERS, and you must retire under an immediate, non-disability retirement before age 62. You are not entitled to the supplement if you retire on a minimum retirement age plus 10 retirement. Minimum retirement age plus 10 retirements are also subject to an annuity age reduction, which we will discuss in a moment. If you retire before you reach your minimum retirement age under an early optional or discontinued service retirement, you have to wait until you reach your minimum retirement age before you can start receiving the supplement. There are no cost of living adjustments on FERS annuity supplements. With these formulas, you can calculate your basic annuity, but your basic annuity may be subject to some deductions. Under CSRS, your annuity could be reduced based on your age, non-deduction service, which is federal service when you contributed to Social Security but not into the CSRS retirement fund, electing a survivor annuity, refunded service, when you were paid back for your CSRS contributions after leaving the government, and a CSRS offset. Under FERS, your basic annuity can be reduced based on age if you elect a minimum retirement age plus 10 retirement, and it can be reduced if you elect a survivor annuity. If your FERS annuity has a CSRS component, it can also be reduced by non-deduction service, refunded service, and by the age you retire. If you retire under CSRS, there is a 2% benefit reduction for each full year you retire before age 55. This reduction is permanent. It applies to both CSRS annuities and also to FERS annuities that have a CSRS component because the employee worked part of his or her career under CSRS. FERS has no age reduction as long as you retire at your minimum retirement age with 30 years of service, at age 60 with 20 years of service, or age 62 with 5 years of service. But under FERS, you can also retire when you reach your minimum retirement age with just 10 years of service. But your annuity will be subject to a 5% permanent reduction for each year you're under age 62. This reduction also gets prorated to factor in every single month between your age and 62. This reduction can be a significant hit to your annuity benefit, so consider this when deciding when to retire. If you want to retire earlier without subjecting your FERS annuity to an age reduction, consider a postponed annuity. With a postponed annuity, you're eligible for a FERS retirement, but you delay the start of your annuity until you reach the age needed to avoid reductions based on your years of creditable service. For example, if your minimum retirement age is 56 years old and you have at least 10 years of creditable service, you could retire, but you would face a 30% permanent reduction to your annuity for retiring before age 62. But if you delayed the start of your annuity until age 62, you can avoid this reduction. To elect a FERS postponed annuity, you must be at or above your minimum retirement age with at least 10 years of creditable service. At least 5 of those 10 years must be civilian federal service. So with a FERS postponed annuity, you're eligible for a FERS immediate annuity upon separation, but you choose to delay the start of your annuity benefit to avoid age reductions. You will not have FEHB health insurance or FEGLI life insurance during the delay. But once your annuity begins, if you were eligible to continue FEHB or FEGLI at the time you retired, then you can reinstate those insurance benefits. This is not to be confused with a FERS deferred annuity, where you are not eligible for a FERS immediate annuity upon separation because you retire younger than your minimum retirement age and/or you retire with less than 10 years of service. In this case, you would lose your FEHB and FEGLI insurance benefits when you retire, and you would not be able to reactivate them later even after your annuity begins. Use Form RI 92-19 to apply for a FERS postponed or deferred annuity. The form is available at www.opm.gov/forms. If you want to help protect your surviving spouse's financial security, you can arrange for a survivor annuity. After your life ends, your surviving spouse keeps receiving some of your retirement benefits for the rest of their life. This is also the only way for your surviving spouse to continue your health insurance coverage after your death. But electing an annuity for your survivor will also reduce your annuity benefits while you're alive. There is a survivor annuity election reduction if you elect a survivor annuity to a current or former spouse. If your former spouse is entitled to a survivor annuity due to court order, or if you elect to provide anyone with an insurable interest annuity. If you retire under CSRS and elect the maximum survivor annuity, your survivor will receive 55% of your base annuity after you die. Alternatively, you can elect for your survivor to receive 55% of a smaller annual amount. Either way, the amount of your annuity you tie to your survivor is called the elected survivor base annuity. But how much will electing a survivor annuity reduce your annuity? Start by multiplying 2.5% times $3,600, representing the first $3,600 of your elected survivor base annuity. Then multiply 10% times the remaining amount of your elected survivor base annuity in excess of $3,600. Add those two numbers and you have your survivor annuity reduction. If you retire under FERS and elect a survivor annuity, you can choose a full survivor annuity or a partial survivor annuity. If you elect a full survivor annuity, your surviving spouse will receive 50% of your annuity after death, and your annuity will be reduced by 10%. If you elect a partial survivor annuity, your surviving spouse will receive 25% of your annuity after your death, and your annuity will be reduced by 5%. By law, as a federal retiree, you must provide your spouse with a full survivor annuity unless you get your spouse's consent for a partial survivor annuity or no survivor annuity. This rule applies even if you are required by court order to provide a survivor annuity to a former spouse as well. An insurable interest is another type of survivor annuity. It's payable to anyone who reasonably expects to receive a financial benefit from the continued life of the employee. A current spouse, when a former spouse already has a court order for a survivor benefit, a child, a business partner, etc. The reduction to your annuity for electing an insurable interest could be anywhere from 10% to 40%, depending on the difference between your age and the age of the person receiving the insurable interest. This is because OPM will be paying the insurable interest benefit to that person for the rest of their life. So electing a young child could impose a significant reduction to your annuity. As we discussed earlier, CSRS offset employees pay into Social Security and will be receiving Social Security benefits. When you are eligible to receive Social Security benefits, your CSRS annuity will be reduced by what's called a CSRS offset. This offset is typically a very small reduction. If you've been working for the federal government for a very long time, you might be wondering about the maximum annuity you can receive. For FERS retirements, the maximum is 80% of your high 3 average salary, equal to 41 years and 11 months of service. A 35-year law enforcement officer or firefighter service can also reach this 80% maximum. And in certain circumstances, you can exceed this 80% maximum with credits for unused sick leave. Under FERS, there is no maximum annuity. If you return to federal service after retirement, you are known as a reemployed annuitant. Generally, you keep receiving your annuity from OPM, and your employment salary is reduced by the amount of your annuity. But there are exceptions to this offset reduction. If your position is extremely difficult to fill, OPM can give your agency what's called a dual compensation waiver and allow you to receive both your full salary and your annuity. Under a discontinued service retirement, your annuity is suspended when you get reemployed, so there is no annuity to offset your salary. Presidential appointments are similar. FERS also has exceptions to the general rule that your reemployment salary is reduced by the amount of your annuity. There can be salary offset exceptions for individual cases where OPM grants your agency a dual compensation waiver. Annuities are subject to cost of living adjustments, also known as COLAs, to reflect the changing costs of goods and services over time. FERS retirees begin receiving their COLAs the first December after retirement. Your first FERS COLA is prorated based on the month in which you retire. FERS retirees generally do not receive a COLA until the December after your 62nd birthday, but you may be eligible to start receiving COLAs earlier if you retire under a disability annuity, law enforcement officer or firefighter annuity, or an air traffic controller annuity. Under FERS, your COLA equals the percent change in the Consumer Price Index. Under FERS, your COLA depends on the change in the Consumer Price Index from year to year. If it's 2% or less, your COLA equals the amount of the Consumer Price Index change. If it's 2 to 3%, your COLA equals 2%. And if it's more than 3%, your COLA equals the change in the Consumer Price Index minus 1%. OPM typically processes most retirement applications in 60 days or less, depending on whether they receive all the records they need from your current and previous employing agencies. But you have bills to pay and might not be able to wait 60 days to start receiving your annuity. In most cases, as soon as OPM receives your retirement records, OPM starts sending you interim annuity payments that are slightly less than what they project will be your actual annuity. These payments are usually made on the first business day of each month. OPM withholds federal income tax. OPM does not withhold health insurance or life insurance premiums, but that does not mean your coverage ends. OPM will deduct retroactive insurance premiums when your annuity is finalized. If you are more than 15 years away from retirement, you can do some long-term planning by finding your FERS minimum retirement age based on the year you were born. Also think about what age you might like to retire and see how much creditable service you will have at each age threshold for your retirement system. At age 60, at age 62, etc. If you are about 10 years away from retirement, use the general formula for your retirement system to estimate your annuity benefit. Be sure to factor in any applicable reductions. You can use the Social Security and TSP websites to estimate your benefits with those programs if you have them. If you're about 5 years away from retirement, contact your employing agency's Human Resources Office to plan your retirement application. Your Human Resources Office can help you complete your application and help identify the best age and time of year for you to retire. For more information about retirement, please contact your employing agency's Human Resources Office. Some agencies have a specialized retirement counselor who can provide one-on-one support for your retirement planning. To see if your agency offers a retirement counselor, visit apps.opm.gov/ABO. For information about how to bring your insurance benefits into retirement and what changes you can make during and after retirement, visit www.opm.gov/retiree-insurance. And for information about retiring from federal service, please visit www.opm.gov/retire.